Are you someone that might have some sleepy money or dead money in some retirement account that you'd like to see what your options are in moving that? I'm Kenny Johnson with East West Capital, and I sat down with Marty Campbell from Equity Trust and my good friend Dan Kinley from Connexus Capital to talk about this topic. Most investors don't have a money problem, they have a money location problem. And what that means is, how can I move money to be working the hardest it can be for me right now? And a lot of skeptical first time investors think, well, I just have to have an extra, I guess, 100K liquid to sink into this thing that may or may not go well. So I think you're really going to enjoy this conversation today. If you have a retirement account, such as a solo 401k or self-directed IRA, and would love to use that money to invest into real estate, check out this conversation. I think you're really going to enjoy it and find it incredibly helpful.
Let's just talk about private equity syndication type offerings. Kind of going forward, I'll let people know some of the things they want to look up for, how they can invest, how could they just invest retirement capital kind of going forward. So let me start
Yeah.
off by just introducing myself, if that's okay.
Yeah. Great.
Marty Campbell here with Equity Trust. I've been with Equity Trust since 2017. So what I do on a daily basis is I talk to individual investors that want to redeploy capital in a tax efficient manner across both traditional and alternative assets to kind of maximize growth. So if you look at companies like Fidelity, traditional brokerage houses, those companies will only give you a set list of menu options: stocks, bonds, mutual funds, ETFs. Equity Trust does those as well, but our core business is alternative investments. We still have the traditional markets, but our core business is alternative investments, such as like purchasing real estate, becoming a private lender, investing into private companies, and such. So that's what we're talking about on today's phone call: redeploying your retirement dollars, whether it's at a company or through an IRA, into some of these offerings kind of going forward.
Awesome. Cool. 2017, you said when you started?
Yeah, September of 2017, correct. Yeah.
Has I'm curious, with COVID or even like last 5, 6 years, what's the like temperature or volume been like for you guys over the last few years?
Yeah, we've been doing this since 1974, so we're in our 50 years of existence. We're still owned and operated by a family. A father, Dick Dessich, and his two sons now are involved in the business. So, I drove past this building many, many times on the highway, had no idea what they did. I moved back from Chicago and came back home here to Cleveland, Ohio, and I met somebody that worked at Equity Trust, and they said, "This is what we do. Would you like to interview there?" And I said, "Sure." So it's been a complete joy seeing clients now take their retirement dollars and learn how to truly diversify their assets. We always talk about diversification here at Equity Trust, but if you're diversifying just into the stock market, that's fine to do as well. I still do the stock, bond, and mutual fund market, but now I'm taking my capital and I'm just learning different ways that my IRA can be diversified into assets that are no bearing on the stock market whatsoever. So, there's about 100 different investments our clients do, some more complicated than others, kind of going forward. So I have the discussion with clients, make sure it's allowed by IRS rules and regulations. And now they're creating revenue drawers. I always say chest your drawers. When I was a kid, my mom said, put your clothes in your chest your drawers. And now I always tell people it's just that chest your drawers being pulled open. And now you have 4 or 5 different chest your drawers that are creating revenue for myself, including stocks, bonds, mutual funds, along with the alternatives that we do. And the good thing about an IRA is once you have an IRA, you're able to shift and lift that money from where it's at to Equity Trust back to another IRA company. So you can always keep your money working for you. You never really have to have it as cash being uninvested.
Excellent. Dan, go ahead and introduce yourself here. I know you're on the call, and tell people what you do and why this is of interest to you with Marty.
Yeah. So I've got just a quick background, about 25 years plus in commercial real estate. I guess 3 years ago, I decided I was going to try and move some of my money out of Washington State and into other states. And in the process, I met some developers who were looking for some assistance raising capital for some of their projects and brought me in as a fund-to-fund manager. And so I'm raising capital for currently Lumen Woods, same with Kenny. And we're just looking for different alternatives for some of our investors who maybe might want to get some better returns out of their 401ks and their IRAs, or might have lazy 401ks that have been sitting there from another company that they haven't worked at for 20 years. So, yeah, just trying to get some more information on how that might work.
Okay, so great introductions, guys. I think we know at least where we've been and what we're doing today. I think if I'm looking for application, so I'm talking to an investor and they say, I don't really have any money available, but I got this retirement account or something that's, I think doing something for me, or it's growing in some way. Don't know what it's growing at. Marty, could you maybe give me just that, I don't know, from the first phone call where I say, hey, you should call Marty at Equity Trust in regards to potentially moving this over into an alternative investment like the alternative asset like this investment class of apartments. Could you walk me through kind of what that initial conversation looks like and maybe a few steps?
Sure. So the initial conversation is just that, an initial conversation for me to kind of understand where their money, their retirement assets are held at, what maybe they're invested into, and what they're looking to do. Now, with the interaction with you, Kenny, I now have an understanding. When I get an email introduction from you, I really already have a sense of kind of what they're doing, uh, kind of going forward. So I don't need to kind of drag that out of them, kind of know what they're doing per se. So essentially, it's just like, hey, have you had an opportunity to talk to Kenny about this investment? What do you think of this investment? And typically it leads to, yeah, I'm looking to do this with tax efficient dollars. So people that have a current, okay, if you're underneath the age of 59 and a half and are still working for your company, you're not able to move that current retirement account out to equity trust to an IRA unless you leave that position or you reach the age of 59 and a half. Now, for those individuals that are working still after 59 and a half and have a current 401k at a current job, they're able to pick that up. That's just called an in service rollover. You're able to pick that up, move that retirement account over because you've reached the age of 59 and a half. Now, typically in this country, people have 8% of the people have traditional and Roth IRAs that are at Fidelity, Schwab, TD Ameritrade, Edward Jones. So essentially, they don't have to move their whole retirement account over here. Typically, I see private equity syndication offerings have a minimum of like $50,000 or $100,000, right? I always tell people, move what you need over here to Equity Trust. Have that investment for however long you want to have that investment. If that investment pays out, when that investment pays out, if you don't have another investment, which I see quite often happen since 2017, I have a lot of people that call me in 2000. They close their account in 2021, call me back again in 2024 and say, hey, I have something similar that came up. Can I run this by you again? So that's the initial conversation, is just finding out what they want to do, where their retirement capital is, and then them understanding kind of like the rules and regulations, allowing them to partake in a private equity or syndication offering.
Yeah, no, that's really good. That actually created a light bulb in my mind of doesn't have to be like the full account. Some of our minimums into these deals are 50K. So you're looking for some diversification. You got all this money in this one specific thing. You can pull out a portion of it and put it into a alternative asset if that's something you want to do.
You can, and now you're just companies like Fidelity, Vanguard, Schwab, they just don't want to do the record keeping and reporting that we have to do on our end. So the IRS makes us do a lot of record keeping and reporting on the back end of our end. That's why there's not many people in this space. Kind of going forward, you're going to get a couple of people in the space, but again, they may get there at some point. It's just, Fidelity is right across the street from me. They have a brick and mortar building with 3 people in there, right? They don't want to have the 500 people that Equity Trust has
Okay.
in a location to do all the record keeping and reporting. That's why, we're known as custodian in the industry. We're permitted to hold these type of alternative investments kind of going forward.
Got it. Dan, you got a question? I got some more for Marty, but any things that he said spur any questions on your mind?
No, I like the fact that, if somebody, it's a new relationship for most of our clients, right? It's a new relationship with Equity Trust to start with just what they need to get into an investment. I actually really like that concept.
Yeah. Marty, since you've been working with I know you have a lot of other clients besides just Dan and I, but with the Kansas City group, and I don't even know if this is like private, so I can edit this out if it's not. But have you helped with how many like investors have you worked with the Oak IQ? That might I just feel like it's a pretty big number. It feels like, but
Yeah, it is a large number. I couldn't say. I mean, they're
okay,
they're they're coming in every day from like multiple syndicators. I get
okay,
copied on emails all the time saying, "Hey, this is my syndication." If it's brand new, Let's say you have a brand new syndication that's just starting. We just need all the corporate documents for us to have those on file. So that way, your first investor doesn't really need to get those to us. The paperwork's pretty simple. We have an onboarding specialist here at Equity Trust that holds the hand of that individual investor and
Hmm.
makes sure that everything is done. They'll tell them when the funds are here from the company that they're sending them to. They'll help with the investment documents and they'll help them log in online. So again, I'm not going anywhere. I still have people to this day that call me since 2017 and say, "Hey Marty, it's Gary. Do you remember me?" I'm saying, "Sure I do, Gary." We get a laugh off of it. And he's like, "No, you don't." So not a big deal. But people are just looking to diversify. And if you need assistance, that's why we have 500 people here at the company.
Yeah, I actually had no idea the 500 number, or is it you said 50 years, so I think that was one of my, concerns or beliefs is like, this is a new thing that's, untested, unproven in regards to moving money out of, this safe and secure, scripted thing that a financial advisor says, "Hey, keep your money here, and if you do over here, you're walking on thin ice, you don't know what's gonna happen." I'd like to squash that belief if
Yeah, we were a brokerage firm back in 1973 or 1974, sorry, and then Dick Desich, the owner of our company, he actually did a triple net lease on a Walgreens property, kind of similar to a Walgreens property where you put just a tenant in there and the tenant kind of takes care of everything
Mhm.
kind of going forward. So that's how he found out that you could utilize your retirement accounts differently. He was the first person to kind of invest alternatively, and that's how the company grew. We found out that you could do private lending. You can lend to an entity, right? You could
Yeah,
purchase equity in a private equity syndication offering, an LLC, limited partnership, or C corporation. So if you don't, so if you want to lend money to the entity, you can. If you want to get equity participation in the company, you can. Every entity syndication has kind of their offering and the structure that they allow per the terms and conditions of their operating agreement.
gotcha. All right. Let me I have some questions here and it may spur other questions that why would investors use this? So I would think there's a lot of investors that have a financial advisor and this is not on that person's script to invest in this alternative asset. So what would be the benefit in using equity trust to invest in an alternative asset?
Yeah, so I have two financial advisors myself. I have one at Morgan Stanley and one at American Funds. So my financial advisor has some of my money, right? This is just something that I've taken on, I've done my own homework on, and I know this isn't going to fluctuate, right? I know I'm getting an interest rate back or payment back based on the investment that's presented to me. So if I have the stock market that goes up 4% one year, goes down 2% the next year, and then goes down 3% the following year, over the course of 3 years, I'm negative 1%, right? So I'm just taking my money, moving it into an alternative investment that I'm happy with the people that I've studied up on. I've done my homework.
Mhm.
I've seen the returns that my alternative investment is getting. So
Mhm.
again, it's just a way to come over to Equity Trust and invest into an alternative investment that my financial advisor can't custody. My financial advisor knows that I'm taking my money, moving it to Equity Trust, and when that capital returns to me, they're getting my money back because I don't have another alternative investment here at Equity Trust. So again, I'm always looking for investments, right? I'm looking for investment two, investment three, investment four. So in the interim, when that money gets paid back, maybe I'm looking for investment two, investment three. So when the money comes back, I'm kind of timing it up to make sure that I can redeploy that capital into investment two and maybe just send the net profits back to my financial advisor.
Mhm.
Or I can also do brokerage shared equity trust. We have a self-clearing brokerage house. So clients don't have to I don't have to move my money back to Morgan Stanley or American funds. The only reason I do that is because I'm not good at stocks. They haven't really nobody really has cracked the code on like this is the stock that you want to invest into. So my financial advisors kind of know that area. So I'm just paying them a service for them to grow my retirement account. I'm just growing it differently here at Equity Trust, but they always know I always know that retirement account is being going to my nest egg for my retirement years going forward. And I could do these investments till I pass away. It's my side hustle in my retirement years. I can do a private equity syndication investment when I'm retired. I can do a private lending deal. I can do a real estate deal, you know, in my
Mhm.
retirement years. So I don't have to necessarily have income because I have capital in my IRA that I'm able to deploy, and I can pull that out after the age of 59 and a half.
Are most of your clients, and I'm sure this varies, but are they usually in that later years, close to 59 and a half? Or do you see a lot of, younger in the professionals that are in the 401k space, reach out?
Yeah, I'm seeing a little bit of everything. I'm seeing the young people, they may, like Dan said, they may have a 401k just sitting there doing nothing that they moved on to job 3. They're underneath the age of 30 and they've already had 3 jobs, so they have 2 401ks just sitting there doing nothing, right? They don't even know they have the opportunity to move this out to an IRA and gain an interest in some of these alternative investments. We also see people later in life that have a larger nest egg and they're like, hey, I don't want all my money in the stock market. I want to diversify outside of the stock market into these alternative investments. So our company is basically for anybody that has a retirement account going forward. Anybody that want, even if they don't have a retirement account, we have people that just start a retirement account from scratch and put earned income in there. I just told my nephew the other day he got his first big boy job. And I said to him, I said, make sure you put $7,000 into a Roth IRA every year. And that's what he's doing. So by the time he's 40 years old, 40 times 7 is $210,000 in there. By the time he's contributing for 4 years, he may be 60, but now just on contributions alone, he's going to have north of a $250,000 just on contributions alone. So even if you don't use equity trust, use some sort of retirement account to get money in, that's your nest egg in your retirement years.
Marty, another one that I feel like, you don't know what you don't know kind of stuff. And obviously I think you mentioned the information, due diligence, vetted team, the reason these alternative investments aren't on this financial advisor's radar is because it's not a known thing. I mean, they may have their
Sure.
proven track record, with the deals that they've done, but they're not on a Schwab account or whatnot. So I know that's a big thing is vetting that specific system. And that's not your job to do that. That's the investor's job and the person moving the money over. But in regards to pitfalls and things that are dangerous, things to avoid, anything that you've seen happen that you could share on ways to stay protected?
Yeah, so a couple of rules that you maybe want to follow. I mean, obviously, you're going to do your due diligence. You're going to talk to people that are maybe already in this investment. Everybody knows everybody. So people that are already in the investment, know how this investment is performed. If you're running multiple private equity syndications, you're going to have a past history there as well, kind of going forward as to what it provides to the client. Pitfalls I see is somebody that maybe is an officer or manager of the company. If they're getting personal benefit, they wouldn't be allowed to invest in these type of syndication offerings. Somebody that owns more than 50% or has control over the checkbook, we don't want them to be an investor kind of going forward. Somebody that sits on a board is fine as long as other people sit on the board. Obviously, no cannabis related item or investments as a present. We get that. But again, it's just, we're a custodian. We're moving the money upon the client's direction. We don't really vet investments out. We make sure they're allowed per the IRS rules and regulations to make sure that the IRA is an entity that can make the investment kind of going forward. But every investment's a risk. I'll say that. The more due diligence you do, the better.
Yeah. Another thing that recently happened with one of my investors was they had 2 different accounts. It was actually a husband and wife, and they were trying to put both accounts I think there are 2 Roth accounts into this specific deal to hit like a 50K minimum investment. Was that, jumping through a lot of hoops there, or have you seen that before with other individuals, couples, perhaps?
Yeah, it's really not. It's called a fractionalized loan or a fractionalized equity participation into an investment. So let's say I had $20,000 and let's say my wife had $50,000. Some entities may allow both of those transactions to happen at once. Like the wife makes an investment, I make an investment. We meet the $50,000 minimum. Some private equity companies say, no, our minimum is our minimum. That's what's on our form. So typically what I see is somebody will create a general LLC, like a canned LLC, where they could be the manager of that LLC. And then these 2 IRA funds, we send the 2 IRA funds directly to the LLC, and they're just percentage members on the LLC operating agreement. And then the LLC makes the investment into the private equity syndication offering as one minimum kind of going forward. So again, and that's That's the whole conversation that I have is, hey, what are you looking to invest into? Where are those funds coming from? You could also use your personal cash and your IRA on an investment. So if you can't meet a minimum and you want to get in, some entities will allow you to move your cash into the deal with your IRA. They're just two different funding sources. Have I seen children invest into private equity companies? Of course I have. Somebody that's maybe self-employed and maybe is paying their children some W-2 or 1099 income, those children can have an IRA. I don't have a small business. I wish I did. I'd pay my two kids if I did, but my two kids now are young. They just have regular CISA accounts. They're called covered educational savings accounts for the children. But as soon as my children are 14 and start to work, they'll get Roth IRAs because they can put more money away, and now they can truly start. Maybe $7,000 doesn't do anything for my children per se, but now once they get to 14,000 or 20,000, now I can start coming into deals with them. My wife can start coming into deals with them, and now we can have four people in one particular investment together, so everyone gets a piece of the pie.
Tell me, I'd like to hear more about that. So basically, by adding your family members into one specific deal that has a really good return potentially, they get tax free. Why would you do that with your family member? Could you just explain that a little bit more? The benefits of that?
Yeah, yeah. So let's say my son and my daughter have earned income and they have Roth IRAs. My wife and I have both Roth IRAs. If I'm putting a $100,000 minimum into a private equity syndication offering and they're giving me, let's say, I don't even know what the an appropriate number to say, but let's say they're getting 15% interest back in 3 or 4 years, right? That's fair to say, correct?
Yeah. Each
Yeah,
year.
yeah, each year. So now my wife and I are getting interest back into our retirement account based on our prorationate pro rata percentage ownership. My children are now getting that proportionate percentage. So now maybe I sneak out of that deal and maybe I get back in it and maybe my kids are a larger percentage owner and I'm a smaller percentage owner. So it's just, I put the family into the mix because whether I have brothers and sisters, nieces and nephews, children, my wife, my parents, even my business colleagues, right? If I have a sound investment that is producing capital for my IRA, I'm going to tell the masses, right? Because I'm already in that investment. So I'm going to tell anybody and everybody that I love to be like, hey, this is the investment I made. This is what it's paying back. Do you want me to introduce you? And then it's just up to them. But again, if I did my own due diligence on a private equity syndication offering, it's providing me capital, like you said, every year back into my retirement account. And mind you, I have a Roth IRA. That's all tax free growth. I never have to pay taxes on that when I take a distribution. 20% or 15% is better than a fluctuation of the stock market.
That's great. One other thought I had was some of these deals, these alternative assets, they may be expired in 5 to 7 years. You
Uh-huh.
put in 100. By the end of year 5, they've given you 200 back, so you've doubled your money. What happens at that point with you? All the investors, the deal's done. Do they, I guess, redeploy that, or that can just sit there, or it's all tax free if it's in a Roth? Correct.
Yeah, correct. And it grows tax deferred if it's in a pre tax traditional retirement account going forward. So basically, what happens when the investment pays out, clients can keep their retirement funds here. They can go to our website, they can go to a YouTube channel, learn about additional investments that they've never considered or ever been aware of. Like I told you, we have plenty of people that are in the real estate game. They're buying physical real estate, owning it, flipping it, buying raw land. For those people like myself, I'm doing more private lending. I'm lending to individual investors in the real estate space here at Equity Trust. So now it doesn't make sense, guys. If they don't have an alternative investment, it doesn't make sense for them to keep their money here and pay an annual maintenance fee just based on balance. So again, if they ever close their account, there's just $250 that they have to pay to close their account. We send that money back to Charles Schwab, E-Trade, Fidelity, wherever they're at. And then not surprising to me, but 3 years later, I'll get that call to say, hey, I was somewhere. Somebody talked to me about this again, and I'm looking to get back into this. Can you reopen my account? I have to tell them, no, I can't. We have to get a new account open, but that's the least of my worries. They're just moving money over, making
Mm.
this investment. So again, they're just using us as an intermediary to hold an investment that their company can't hold. And then when they get profits back in, and make the decision, hey, equity trust might have some other alternative investments that I may be interested in. I may just do stocks, bonds, and mutual funds with equity trust. I may look to do other stuff. They keep their money here, or they just move it out. So again, we don't care whether they move it out or move it in. We're just a catalyst to provide an experience that a Fidelity, Vanguard, or their 401k can't currently custody.
That's an interesting point. This isn't a you think the stock market, my dad's someone who would just say, "Don't ever sell. Just keep adding in. Don't move it. Just kind of invest it and forget about it until, you're 59 and a half or whatever." You are someone who does, private equity lending. So you may be, I don't know, 6 months here, 12 months here, 24 months here, depending on who you're working with in regards to, flippers or whatever until they refinance on it. A lot of the deals that Dan and I look at, they're anywhere between like a 3, 5, maybe 7-year hold. So, I mean, I would think the average investor doesn't want to be constantly worried about, managing their money as maybe, well, it depends on how active or passive you want to be. But, that passivity, I think, is what's attractive is, hey, I'm going to put this thing here. I know how hard it's working for me or what it's projected to produce, and I'm happy with that. And then I can, spend my time with my kids or family or whatever else you're working on, your business.
Yeah. Yeah.
But there's options is kind of where I'm going is you don't have to just do the one track minded, like put in the stock and just forget about it. Is that right?
Yeah, and like you said, set it and forget it. That's exactly what you're doing on a private equity syndication offering. You're setting it up and it's working for you for the next 5 or 7 years,
Mhm.
producing capital back in. So you're not worried about the fluctuation of the stock market going up and down. You have a track record that companies have. But again, I can't stress enough that the clients have to do their own due diligence kind of going forward.
Roger that. Marty, that really covers a lot of my immediate questions. I'm sure there's going to be some more that I think of after this call. But Dan, you got anything else to add with while we got Marty with us?
Not really. I really do like Equity Trust, the platform you guys use and how it, how I guess open you are to people moving stuff in and out. So it's not because I know some financial advisors get really protective about losing an account or moving money out of their account. And for you guys, you're just trying to help people facilitate what they're trying to get into or what their needs are. You're just trying to help with that. So I really do like that platform.
Right. And the other thing I see in private equity syndication offerings is especially later you were asking me, Kenny, about young kids, older people that are looking to make the investment. Now, what some clients do to make themselves more tax advantaged is do a conversion from a pre-tax retirement account over to a Roth IRA. So that's something that maybe clients might want to look at in the future to be more tax advantaged. So you can do it cash or deal specific. So I could take your investment, I could move the whole thing over to a Roth IRA. I just have to pay the taxes, right? But if you look at a Roth IRA, once I take a distribution from a Roth IRA, I pay 0% in federal taxes as long as that Roth IRA is open and seasoned for 5 years and I'm over the age of 59 and a half. I also avoid RMDs. So RMDs happen at 73 and a half in a traditional IRA, going up to 75, I believe, in 2032. So if I don't want to take any money out of my retirement account, I never have to out of my Roth IRA. I can now leave that nest egg to my children or grandchildren. And the IRS made a rule back in 2020 as part of the Federal Secure Act that said, hey, if my children get my retirement account, if I leave it to my spouse and my spouse passes away, our children get it, they have to distribute those funds within 10 years after they get it. So if they're distributing funds from a Roth IRA, they have the full kit and caboodle in my Roth IRA to do what they want to with it. I mean, if I have a traditional IRA, they're still getting a nest egg. They just have to pay taxes based on the effective tax rate of the person or them at the time they take the distribution. So again, many creative strategies that clients can do. We offer estate and planning services here at Equity Trust as well. So there's multiple accounts that clients can have as well. If your investors are self-employed, they can get a self-employed retirement account. If they have a W-2 job, they could get a traditional or Roth IRA. A lot of self-employed individuals also have HSAs. So a health savings account can also be self-directed kind of going forward. And you can revert back all the way back and pay bills. My boss says it every day here. He's like, Marty, do not pay your HSA bills now. Just let that grow, 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 and grow. And you can go back many, many years and pay your HSA bills kind of going forward. You
Wow.
can reimburse yourself.
So what I heard is if anyone is unsure about their position, we need to get them on the call with Marty ASAP. Well,
Yeah,
wealth of knowledge.
Yeah, like you do, just a soft introduction email. I'll reply to that email, say thanks for the introduction, and I'll help those clients out. I've, got a lot of knowledge
Yeah.
being 9 years here at Equity Trust. So again, happy to, and I can't thank you enough for the relationship that you built with myself and Equity Trust. I'm very appreciative. So again, happy to help accordingly.
Yeah, I mean, I think that's the win-win here is Dan and I, we don't know all the answers to these things. We're trying to bridge these hardworking, busy business owners for myself. That's kind of who my target audience is, business owners, dads who are, trying to make more time, more margin for their family. And to go through the questions and headaches of what we're talking about, it's not how to do it, it's who do I know that can do this stuff? And I
Sure.
don't know what I don't know. So yeah, we love this relationship. I'm hoping to, preach the good news just like your boss was telling you, like those types of things where we're just trying to get the money these people are earning as hardly earned as it can into their account instead of someone else's.
Yeah, absolutely. Again, clients can go to our website. Our website is trust and then etc.com. It looks like trust, etc.com. Trust and then the initials for etc.com if they want to learn more about our company. We do also have a YouTube channel that's very beneficial for new investors so they can see how other investors are investing their retirement accounts, including but not limited to syndication offerings like you're offering. So again, this is what we do and this is who we are. This is who will always be. And clients are now just diversifying their retirement account into alternative assets, including yours.
Love it. Thank you, Marty. Thank you for your time. Hopefully today, guys, we've learned that pushback that I get is, I don't have any money to invest right now. There might be some money laying on the sidelines. I think Dan called it dead money, sleepy money, that we can get that thing moving to get into these alternative assets that have a much higher rate of return. And with some due diligence and vetting, we can help get that money working hard for you. Marty, thank you again for your time, buddy.
No problem,
We'll
guys.
see you on the next call.
All right. Have a great day. Take care.
See
Thank
ya.
you.
Bye.
Bye bye.
Okay.